Do you know what's the #1 way to make your financial model dynamic? Build a cash sweep and a revolver that will automatically cover any cash shortfall and be repaid right when you have excess cash. This is the soul of dynamic modeling, and I will show you a simple way to do it. Before we even start building this cash sweep and this revolving credit facility, just let me show you the situation here on this company. We see that despite the revenue being growing every period, we see that there are some periods where the cash is negative. It ends up positive. You can see that the ending cash at the end of those 8 years, it's positive, but there are some parts of the period that it's negative. So we can see right here in the cash flow statement that we have, it's negative cash flow in 2025 and in 2027. So we are going to implement this cash sweep and this revolving credit facility to cover for those periods when cash becomes negative, when we need an extra cash to cover for the obligations. So let's start by building a new schedule right here, and you can see that this model is complete. You see the income statement, the cash flow, and the balance sheet. You find some assumptions, and we have the operating schedule with the revenue, cost, working capital. Then we have the investing schedule with the fixed assets and the depreciation. And you have the financing schedule, which is the one that we are going to add something right now, which has the equity and the debt, the fixed debt, and now we are putting the revolving debt. If you want to get this model, the link is going to be on the description. So let's start by building right here a revolving debt. And to build a revolving debt, I start by defining how much cash I have free or how much cash I need to borrow in my revolving debt. So this needs to be the part that makes the model dynamic. So I'm going to build a free cash flow. This is not the same, it's almost, but not the same free cash flow that we are used to see when we are building a DCF model for valuation. This is a free cash flow that will determine how much cash I need for the revolver. So to do that, I'm going to start with my beginning balance. And I'll grab from my cash flow everything except for the revolving debt. So to do so, I'll get the operating cash flow, I'll get the investing cash flow, but I'm not going to get the total of the financing because the revolving is included right here. So I'm going to get all the other items here. And those are my obligations. This is the obligation cash flow that I have every period, and that's what I have to count for the revolver. I'm going to paste right here. Let me make this bold. Let me do some adjustments so it will look good. And that will bring me my ending cash. My free cash flow, let's call it better. So let's start by linking everything. So I'm going to link this to my beginning balance in my cash flow. It could be also from the balance sheet. It doesn't really matter, but I'm going to link here on the cash flow. Then I have my operating cash. I have my investing cash. And the other items from the financing cash, except for the revolver. So let's start on long-term debt. And now I can pull because they are one after the other. And this is the sum of everything, is my key, free cash flow. Let me just adjust the format and pull to the side. So now you notice that I have 8 million on the first period. I have a need of cash of 2.7 million on the second period. Now I have leftover cash of 4.3 million. Then I need cash again in 2027, and then I end up 2028 with some cash in the bank. So I'm going to use that, but I'm going to consider also another assumption that I have here that is very common. I have a minimum cash requirement. So other than covering for that cash, I also need to keep 5 million minimum in the bank. So I'm going to consider that in my formula as well. To calculate how much I need to borrow and how much I will need to pay when I have money extra on the bank, I will create a corkscrew schedule. So, and that's for the revolver balance. I'll show you how a corkscrew schedule works. We start with the beginning balance of any balance sheet account. Then we are doing the movement of that account. In this case, it's the issuance or repayment. Notice that I'm putting in parentheses because that's a negative. If it's negative, it's going to be repayment. If it's positive, it's going to be issuance. That's going to be the increase or decrease of this balance sheet account, the revolver credit facility. And I'll end up with the ending balance. And this ending balance is for this account. So I will start by bringing the ending balance of the last actual period that I have. So I'm going to link this directly to the balance sheet. I didn't have any revolver before, so I'll just link in the 0 right here. And the ending balance becomes the beginning balance of the first period that I'm calculating. So I'm going to link right here on the ending balance. And this one is going to be the sum of those two. And now I can put a line right here, and I can put all of this to the other periods. Now what I need to calculate is how much I need to issue and how much I can repay every period based on the free cash flow. So I'm going to use a formula called minimum, and that's because I need to issue exactly the minimum amount that I need, and I need to repay at most what I have in the bank, not more. So that's why I use this function called minimum. So it's going to be negative because of issuance and repayment. So negative minimum between whatever I owe already, which now is nothing, and my free cash flow, whatever I need to borrow or whatever I have available to repay. But I also need to consider my minimum cash requirement. So I'm also going to add here, and I'm doing a negative because the whole formula is already negative. So to add, I'll add minus. And I'll add my minimum cash requirement right here. So now let's pull this formula and see how it looks. So let's analyze this. On the first year, I didn't need to borrow anything because I had in the bank 8 million. It was above the minimum cash requirement of 5 million, so it was fine. On the next year, I needed 2.7 million, but I needed to keep 5 in the bank, so I borrowed 7 million right here. Then that's how much I owe now. And then on the next year, I made 4, but I cannot repay whatever I owe because I need to keep 5 in the bank. So I had to borrow a little bit more to cover for the 5. So I borrowed 600 more. Then I start owing 8 million. On the next year, I also needed 2.8 more. I already owed 8 million. I also had the 5 million minimum cash, so I borrowed 7. And I end up with the debt of 16 million. And then on the next year, I make 5, and I end up being able to pay a little bit of my debt, just a little bit, just the 76, because I had to keep the 5 million in the bank. So let me just adjust the format of this. And this is my balance in the balance sheet for the revolver credit. So now I'm going to calculate how much interest I owe on this. The thing is, the interest is, ideally, we would use the average between the two balances. And that's because we don't know for sure at what point in the year we got this debt. But if we do so, if we use the ending balance to calculate the interest, once we put this interest back in the income statement, what's going to happen? The income statement is going to influence the cash, and the cash is going to influence the free cash flow. And what happens is we are going to have a circular reference. In this case, I want to keep it simple. I want to avoid circular reference, and that's what I advise you to do most of the times. You can start by creating a model that avoids circular reference and just use circular reference if it's needed, or try to solve another way. Today, I'm going to solve by using the beginning balance instead of the average balance. So here I'm going to calculate the interest, and based on the beginning balance times my rate. Now, I have 3 outputs from this schedule that I just created. I have the balance that goes to the balance sheet. I have the movement of this account that goes to my cash flow statement. And I have the interest that goes to my P&L, to my income statement. So let's link that and see how this balances the balance sheet and see how the cash looks like afterwards. So I'm going to start by linking the balance sheet right here to my ending balance of the revolver. And once I do that, you can see that now my balance sheet is not balancing anymore. And that's because I need the other side of the equation, which is the movement in the cash flow. So let's go to the cash flow. And this should be 02. Let me just copy and paste this right here. And this one, I start linking right there. And that's going to be in the issuance or repayment. And the last piece is going to be the interest, but I already had some interest calculated right here. I'm just going to bring this to the bottom. And I will add a line right here called the Revolver. And let me just adjust this. So look okay. And I'll link this one right here and add to the total. So these cells right here were already fitting my income statement on my net interest expenses. And now it's including whatever interest expenses I have for the Revolver. Let's check our balance sheet balances. We already put the interest in the income statement. We have no circular reference because we use the beginning balance. So now let's see how it looks. We have positive cash flow every year. And we can see right here that the minimum cash flow is being taken into consideration. I never have, after on the forecast years, of course, I never had anything below 5 million because that's my minimum cash requirement. So that's it. You just built a clean, simple, and fully dynamic cash sweep using a Revolver. If you found this useful, hit the like button, subscribe to the channel, and check out the video I linked on how all schedules tie together in a 3-statement model. Thanks for watching, and I'll see you in the next one.